Most people believe that the only way to beat the stock market is to buy more stocks, tech stocks, dividend stocks, penny stocks. But the ultra-wealthy have quietly been beating the S&P 500 for decades by investing in things you can hang on a wall, pour into a glass, or strap to your wrist. In 2025, while the S&P 500 returned 17%, a rare bottle of single malt scotch delivered over 24% in a single exit. A Patek Philippe watch gained over 16% in the secondary market. And a carefully chosen blue chip painting appreciated 11.2%, quietly compounding through market crashes that wiped out stock portfolios. The wealthy call these passion assets, investments you actually enjoy owning. But here's the problem. For every investor who makes a fortune on a Basquiat painting or a 50-year-old Macallan, 100 others get crushed by fakes, storage costs, and illiquidity. If you stay until the end of this video, you'll learn exactly how to invest in art, whiskey, and watches the right way. I'll show you the specific returns, the hidden risks, and the platforms that let you buy fractional shares of million-dollar paintings and rare whiskey casks with as little as $20. You'll never have to choose between passion and profit again. My name is your name, and today we're turning your hobbies into assets. Let me start with a story that will make you rethink everything you know about investing. In 2018, a financial analyst named James bought a painting by the artist Jean-Michel Basquiat for $5,000 at a small auction. He hung it in his living room and forgot about it. In 2024, a dealer offered him $50,000. He sold it. That's a 900% return in 6 years, far outpacing the S&P 500. Across the Atlantic, a whiskey collector named Sarah bought a cask of 25-year-old Macallan for $15,000 in 2015. She stored it in a bonded warehouse. In 2025, she sold the bottled whiskey for $65,000, a 333% return. And in Geneva, purchased a stainless steel Rolex Daytona for $18,000 in 2020. By 2025, its secondary market value had climbed to $32. Zhuozhu, a 78% return, while the broader market was flat. These are not outliers. They are part of a broader trend where alternative assets have quietly outperformed traditional investments. But for every James, Sarah, and Geneva dealer, there are hundreds of horror stories. The art collector who bought a Warhol that turned out to be a forgery. The whiskey investor whose cask evaporated due to poor storage. The watch collector who bought a rare Rolex that was actually a Frankenstein of aftermarket parts. The difference between the winners and the losers is not luck, it's knowledge. And today, I'm going to give you that knowledge. The market for alternative assets has exploded in the last decade. According to the Art Basel and UBS Global Art Market Report 2026, global art sales reached $59.6 billion in 2025, up 4% from the previous year, surged 9% to $20.7 billion. The art market had a remarkable rebound in 2025, returning to growth in almost every region after 2 years of contraction. The Art Price 100A Index, which tracks the 100 top-performing artists in the contemporary art market, rose 11.2% in 2025. To put that in perspective, that's nearly double the long-term average return of real estate and significantly less volatile than the stock market. The whiskey market tells a similar story. The global whiskey market is projected to reach $62.29 billion in 2026. Whiskey investments have a track record that rivals top-performing equities. Historically, top bottle brands have delivered annual growth in the region of 8% to 20%. The Knight Frank Luxury Investment Index and the Rare Whiskey 101 Apex 1000 Index tracked a decade of explosive growth, with the Rare Whiskey Icon 100 Index rising nearly 600% in the 10 years leading up to 2019, even after a cooling period in 2024, which experts describe as a necessary stabilization rather than a crash. Rare whiskey investments have continued to post impressive returns. A whiskey exit in February 2026 achieved a return of plus 30%. Another exit in September 2025 achieved an average return of plus 24.3% over a holding period of just 14 months. The luxury watch market has been equally impressive. A 2026 wealth report estimated the average gross return on investment for watches to be 34%. Rolex prices in particular have shown remarkable resilience. According to WatchCharts data, the Rolex market index was up 7.9% year-over-year as of March 2026. Patek Philippe appreciated 16.2% in the 12 months ending February 2026, while Tudor gained 11.4% and Rolex added 7.9%. Even in the first months of 2026, the watch market has continued its recovery, with the overall market index gaining steadily for 6 consecutive months, following a technical floor reached in August 2025. The WatchCharts overall market index gained plus 2.1% in April 2026 alone, with Rolex appreciating plus 2.5%. Now you might be thinking, this sounds great, but I don't have $50,000 to buy a Basquiat or a Rolex. That's where the revolution in alternative asset investing comes in. Over the past few years, fractional investing platforms have democratized access to these markets. You no longer need to be a millionaire to own a piece of a multi-million-dollar painting or a rare whiskey cask. Platforms like Masterworks allow you to buy shares in blue-chip contemporary art for as little as $15 to $20 per share. Masterworks has grown to over $700 million in assets under management with over 900,000 investors. For wine and whiskey, platforms like Vint let you invest in professionally curated collections of fine wine and rare whiskey with shares priced as low as $25. Vint handles all the storage, insurance, and provenance verification. You just buy the shares and watch them appreciate. But before you rush to download these apps, you need to understand the risks and the costs. These platforms are not charities. Masterworks, for example, charges a 1.5% annual management fee and takes 20% of any profits when the artwork sells, a fee structure that can dramatically eat into your returns. Vint charges a one-time sourcing fee that can range from 0% to 35% of the purchase price, depending on the offering, and the capital is often locked up for years. Masterworks holding periods typically range from 2 to 4 years or longer. If you need your money back before the artwork sells, you may have to sell your shares on a secondary market at a steep discount or not be able to sell them at all. And that's just the platform fees. The underlying assets themselves carry unique risks. Art is illiquid. Finding a buyer for a $10 million painting can take months or years. Art prices are also notoriously subjective. What's hot today may be cold tomorrow. The Art Price 100 Index, despite its strong 2025 performance, has a correlation coefficient of 0.88 with the S&P 500, meaning art prices move largely in sync with the stock market. So you're not truly diversifying, you're just buying a more expensive, less liquid version of the stock market. Whiskey investments require specialist storage. A cask of whiskey can lose value if not stored at the right temperature and humidity, and the market has become increasingly crowded. Rare whiskey is no longer a market where almost any bottle will appreciate rapidly. Investors now need to be selective, focusing on distilleries with proven long-term track records. Watches face similar challenges. The market is notoriously fickle. A model that is hot today may be cold tomorrow. and the proliferation of fakes and aftermarket parts means you need expert authentication before you buy. Given these risks, here is my framework for incorporating alternative assets into your portfolio. First, treat alternative assets as a satellite holding, not your core investment. The majority of your portfolio, at least 80% to 90%, should be in low-cost, diversified index funds tracking the global stock and bond markets. Alternative assets are for the fun money portion of your portfolio, the 5% to 10% you can afford to lose if the market turns or a forgery is discovered. Never put your retirement savings into a single painting or whiskey cask. Second, use fractional platforms to access blue-chip assets. Masterworks for art, Vint for wine and whiskey, and platforms like Collectible for watches and memorabilia. These platforms provide professional vetting, storage, and insurance services that would be prohibitively expensive for an individual investor. They also allow you to diversify within the asset class. Instead of buying one expensive painting, you can buy fractional shares in dozens of works across different artists, periods, and categories. Third, do your research before investing. For art, focus on blue-chip artists with established track records. Artists like Basquiat, Picasso, Banksy, and Warhol. The May Moses Art Index, one of the most cited studies of art market returns, found that blue-chip art has delivered strong returns over multi-decade periods, with the caveat that individual pieces can vary wildly. Blue-chip status is earned through decades of exhibitions, scholarship, and consistent collector demand. These are not the latest Instagram sensation. They are artists whose work has been tested by time. For whiskey, focus on established distilleries with proven secondary market liquidity. The Rare Whiskey 101 indices track the performance of thousands of auction results, providing one of the clearest pictures of how rare whiskey prices evolve over time. Consult their data before investing, and pay attention to limited editions. The recent sale of a 50-year-old Glen Scotia with only 100 individually numbered crystal decanters worldwide delivered strong returns because of its extreme scarcity. For watches, focus on brands with deep secondary markets. Rolex, Patek Philippe, Audemars Piguet. According to early 2026 data, around 56% of Rolex models and 63% of Audemars Piguet models still trade above retail. Steel Rolex models appreciated at about 5.6% annually in 2026, with gold models rising even faster. The big three brands have shown remarkable resilience through market cycles. Fourth, understand the true holding period. Art and whiskey are not day trading vehicles. A whiskey investment often requires at least 5 to 10 years for meaningful appreciation. Art requires even longer. Masterworks' successful exits typically occur after 2 to 4 years, but many works are held for much longer. If you need liquidity within 12 months, alternative assets are not for you. If you have a long time horizon and a genuine passion for the asset class, they can be a rewarding addition to your portfolio. Fifth, consider the tax implications. In the U.S., collectibles are taxed at a higher capital gains rate than stocks, up to 28% for collectibles versus 20% for long-term stock gains. Some fractional platforms pass through this tax treatment via K-1 forms, which can complicate your tax filing. Consult a tax professional before investing large amounts. In the UK, the capital gains tax on collectibles is generally the same as on other assets, but specific rules apply. In Canada, collectibles are taxed similarly to other capital gains, but there are nuances around listed personal property. In Australia, collectibles are subject to capital gains tax, with special rules for items costing over $500. Know your local tax rules. Now let me give you some concrete strategies for each asset class. Investing in art. The blue chip pathway. Asterisk, the simplest way to gain art exposure is through fractional platforms like Masterworks or Yield Street's Art Equity Fund. These platforms do the curation, authentication, storage, and eventual sale for you. You just buy shares and wait. According to Masterworks' track record, contemporary art investments have historically outperformed the S&P 500 real estate and gold over certain periods, though past performance is no guarantee of future results. The minimum investment is around $500 per offering at Masterworks. Those secondary market shares can be bought for as little as $15. If you prefer direct ownership, focus on prints and multiples from established blue-chip artists. Blue-chip prints span a remarkable range, from accessible editions that sit well within the middle market band to trophy-level works commanding 7 figures at auction. Banksy prints, for example, have become a popular entry point for new collectors. The key is to buy from reputable auction houses like Sotheby's, Christie's, or Phillips, and to get an independent appraisal before purchasing anything over $5,000. The 2026 U.S. Art Market Report from Bank of America noted that historical and blue-chip artists regained prominence in 2025, while the contemporary segment faced continued price corrections. That means investors are seeking safety in established names, a trend that's likely to continue in uncertain economic times. For diversification across different art categories, new indices like the Art Day Collecting Category Indexes now allow institutional investors to track auction performance across major market segments alongside traditional asset classes. Asterisk, investing in whiskey. A liquid history. Rare whiskey has evolved from a niche collector's passion to a legitimate alternative asset class. The global whiskey market is expected to reach $62.29 billion in 2026. But as the market has grown, the opportunities have become more nuanced. The Rare Whiskey 101 indices track the long-term performance of key whiskey categories and distilleries, with the Apex 1000 Index providing the broadest measurement of the rare whiskey market. The primary decision for whiskey investors is cask versus bottle. Bottle investments often suit shorter time horizons of around 1 to 5 years and tend to offer relatively high liquidity. Historically, top bottle brands have delivered annual growth in the region of 8% to 20%. Cask investments, by contrast, require longer holding periods, typically 5 to 10 years or more, but can deliver higher returns. A cask bought today for $5,000 might be worth $25,000 or more in a decade if you've chosen the right distillery. The best approach for beginners is to use a whiskey investment platform. Vint offers fractional shares in curated collections of fine wine and whiskey, with shares priced as low as $25. The platform handles all storage, insurance, and provenance verification. Another option is the Hong Kong whiskey investment firm pitching private equity-style funds, which have targeted returns in the 13% to 15% range over 5-year horizons. The key is to focus on distilleries with proven track records and to understand that the market has cooled from its pandemic peak. A significant cooling in 2024 was described as a necessary stabilization after years of explosive growth, not a crash. The opportunity now is for patient investors who can hold for the medium to long term. Investing in watches. Time on your side. Asterisk, the luxury watch market has shown remarkable resilience through economic cycles. In 2026, the market continues its recovery, with the overall market index gaining steadily for 6 consecutive months. The Wealth Report estimated the average gross return on investment for watches to be 34%, with overall collectibles reporting growth of 16%. The sweet spot for most watch investors is the $50,000 to $100,000 tier, where the best ratio of liquidity to upside is found. At this price point, you're buying established brands with deep secondary markets, Rolex, Patek Philippe, Audemars Piguet, but avoiding the extreme volatility of the ultra-rare pieces that trade at seven figures. Rolex remains the most liquid brand, with 56% of models trading above retail as of early 2026. The overall Rolex market index was up 7.9% year-over-year as of March 2026. Patek Philippe has shown even stronger growth, appreciating 16.2% in the 12 months, ending February 2026. Audemars Piguet and Tudor have also posted solid gains. For beginners, the safest approach is to buy from authorized dealers or trusted secondary market platforms like Chrono24, Watchbox, or Bob's Watches. Avoid buying from private sellers on eBay or Facebook Marketplace, unless you have the expertise to authenticate the watch yourself. Rolex is the most counterfeited watch brand in the world, and even experienced collectors have been fooled by high-quality fakes. The final verdict: should you invest in alternative assets? Here's my honest take. For the vast majority of investors, the best alternative asset is no alternative asset. A simple, low-cost portfolio of index funds tracking the global stock and bond markets is all you need to build wealth over a lifetime. The returns are reliable, the fees are low, and the liquidity is high. But if you have a genuine passion for art, whiskey, or watches, and you've already maxed out your 401n, Roth IRA, and HSA, then allocating 5% to 10% of your net worth to alternative assets can be both financially rewarding and personally fulfilling. The key is to treat it as a long-term investment, not a speculation. Do your research. Diversify within the asset class. Use fractional platforms to spread your risk, and never invest money you cannot afford to lose. The wealthy have used passion assets for centuries to preserve and grow their wealth. Now, thanks to fractional investing platforms, you can join them. But always remember, a Basquiat on your wall is worth more than just its price tag. It's a piece of culture, a conversation starter, a source of joy, and if it also happens to appreciate in value, that's just the cherry on top. Here is your action plan for today. First, evaluate your current financial foundation. Have you paid off high-interest debt? Do you have a 6-month emergency fund? Are you maxing out your 401n match and your Roth IRA? If the answer to any of these is no, focus on those fundamentals before even thinking about alternative assets. Second, if you're ready to explore, sign up for a fractional platform. Masterworks for art, Vint for wine and whiskey. Create a free account, browse the offerings, read the offerings circulars carefully. Understand the fees. Third, start small. Invest $100 or $500 in a single offering. Treat it as an educational expense. See how the platform works. Track the performance. Get comfortable before committing larger amounts. Fourth, diversify. Don't put all your alternative asset money into a single painting or whiskey cask. Spread it across multiple offerings, multiple platforms, and multiple asset classes. Fifth, ignore the hype. Art and whiskey prices are volatile. You will see headlines about record-breaking auctions. You will also see stories of investors who lost everything. Stay disciplined. Hold for the long term. Rebalance annually. Sixth, comment below. I'm allocating 8% of my portfolio to alternatives. Tell me which asset class excites you most. I'll reply to the first 100 comments with personalized advice. If this video opened your eyes to a new world of investing, hit the like button. It helps others discover the art of alternative assets. Subscribe and turn on notifications. In the next video, I'm going to reveal the 72-hour rule, a simple trick to stop impulse buying and save $5,000 a year. Your passion should not cost you your financial future. Invest wisely, enjoy the journey, and let your assets grow. One masterpiece, one pour, one tick of the second hand at a time. I'll see you in the next video.